All right, so let's talk about freight. Why does freight matter? Well, freight is about shipping. It's about when title transfers, and it captures, based on whatever the shipping terms are, it captures who is going to be the one paying for the shipping costs and assuming ownership of the inventory while it's in shipment. All right, so I made you guys a little train just so I can reference it. There we go. You've got a seller on one end, you've got a buyer on the other end, right? And the train's taking the inventory to the buyer. All right, what if the terms are FOB shipping point? Well, what FOB stands for is it stands for free on board. Old term, but we still use it. I think it goes back to train days, but FOB shipping point. All right. Ownership title passes to buyer when merchandise is delivered to the freight carrier. What this means, FOB shipping point, is it tells you at what point the inventory title, the title of the inventory, the ownership, transfers. Well, the transfer happens as soon as it gets to the shipping point. Right? So as soon as the seller gets it to, let's say, the FedEx or UPS or post office, whatever. As soon as they get to the shipping point, it is no longer the seller's responsibility. Their whole responsibility was only to get it to the shipping point. That's when title transfers. That's what it's telling you here, when title transfers. All right? So that means the person who bears the cost of getting the inventory all the way to them is the buyer. The buyer has to pay for all the shipping and assumes responsibility for the shipping. All right. The seller only has to get it to the shipping point. Title transfers at the shipping point, and it's no longer theirs. It is now the buyer's. So that means if transportation, right, if their only responsibility is to get it to the shipping point, then the transportation costs are borne by the buyer because they have to pay for it to get it all the way to them. And the risk of loss during transportation, also the buyer's, right? The seller only has to get it to the shipping point. All right. Now here's the thing. The costs get added to the cost of inventory. Let's say, for example, all right, remember you're the buyer, you're paying for these transportation costs. Let's say you buy something you're shopping online and you buy something for $20, right? You buy a new stuffed animal for $20. Right, whatever. But it doesn't cost you just $20. It costs you $20 plus $5 in shipping. So really, did that animal cost you $20 or did it cost you $25? So since that shipping is part of your responsibility as the buyer to pay, you are going to add the shipping costs to your inventory. Okay, so it's going to be the $20 you paid for the item plus the $5 in shipping. Right, and that's the point of FOB shipping point. You have to know who's bearing the costs and who is responsible for the items. All right, so let's look at FOB destination. FOB destination is exactly what it sounds like. Title transfers when it gets to its destination, to the buyer. So now the seller has to get it all the way to the buyer before the shipping costs transfer. So it has to be received by the buyer, right? It has to get to its destination. That's the point that title transfers. So that means the seller has to get it all the way to there. Well, that means the seller has to pay for all that shipping. And the transportation loss is on the seller. So if that's the case, the buyer is not paying for shipping, right? The seller is paying for the shipping. So the way the seller treats those costs is they call it a selling expense, right? It's just simply an expense of selling the merchandise, paying for the shipping. When you see like something advertised includes free shipping, that's what's happening. The seller is going to call that a selling expense on their end. The buyer doesn't pay it. All right, so now let's look at the journal entries. This is technically a try it, but I want to work through these with you. March 1st, a women's clothing store purchased $14,000 of merchandise from a supplier on account. Terms FOB destination. All right, so FOB destination means who's paying. It means the seller is paying. We're buying things though, so we don't worry about it. We're not the ones doing the paying. We're doing the purchase side. All right. So on March 4th, we returned some inventory. There's a lot going on here. We pay within discount periods. So let's take it step by step. We journalize the entry to record the purchase on March 1st. Well, we just got inventory. Debit inventory, credit accounts payable. That's it. Okay, so let's draw our T accounts down the side here to keep track. There you go. Journalize the entry to record the return on March 4th. Looks like we returned $2,500 worth of merchandise, so we reduce the liability and we reduce our inventory because we're sending some back. Okay, so here we go. We reduce them. Now we're going to make the payment. All right, and we're paying within the discount period, and the terms are 210 net 30. So it's a 2% discount. So what is easiest to do is let's calculate that discount. 2% on the outstanding balance. Well, the outstanding balance is $11,500. That's a $230 discount. So the cash we're going to pay, we're not going to pay $11,500. We're going to pay $11,500 minus the discount of $230. So there's your $11,270. All right, so we've got a credit to cash of $11,270. Remember, these are our purchase transactions. So we're buying it, right? Credit to cash. We have a debit to accounts payable, but remember, we have to pay the full amount here. $11,500 is what it looks like we're going to pay. Because if we debited this for $11,270, it's going to look like we still owe money, and we don't. So we will debit it for the full $11,500. Right, so now our accounts payable is 0. What do we do with that difference, right? What do we do with that $230 discount? Well, we reduce our inventory by it. There we go. We credit our inventory, and now our inventory is $11,270, which matches the actual cash we paid. Okay, so the discount is applied to the inventory. All right, a little bit more. Let's on freight. SMB purchased $1,000 worth of merchandise on account, terms 210 net 30, FOB shipping point. All right, let's look at that FOB shipping point. So now the seller only has to get it to the shipping point. Guess who's paying for the shipping? Us, the buyer, because we're a purchaser in this case, right? The seller's only responsible for getting to a shipping point, which means the buyer has to get it all the way to us, which is us. We're the buyers, all right? And we had freight costs of $50, and the seller prepaid them, but they charged us for them, right? Which isn't unusual, right? It's part of our bill. So think about what's included in inventory for the buyer. Purchase, obviously the purchase price is included. Any freight costs are included in this case because we're paying for them with it being shipping point. And if we have any taxes, all of those things get included in the cost of inventory, right? So if we're buying a lot of inventory, that's important. It's not like we can leave freight costs off or taxes off. They're all part of the cost of acquiring the inventory. All right, so we're going to debit the inventory for $1,050 because it was $1,000 and they paid the $50 for us. So really it cost us $1,000 plus $50 in shipping because it's our responsibility as the purchaser as FOB shipping point. So we've got $1,050 of merchandise inventory, and we have a credit to accounts payable of $1,050, right? Because we owe them. Now let's figure out the discount because we're going to pay within the discount period. Well, here's the thing. The discount applies to the inventory we're buying, not to the $50 of freight costs, right? Because the freight costs are like FedEx. FedEx isn't giving us a 2% discount. The buyer is giving us, the seller, we're the buyers. The seller is giving us a 2% discount. Okay, so we're going to calculate the discount. Ooh, let's give ourselves our T accounts. There's our $1,050. We're going to give ourselves a discount on the $1,000. There you go, $20 discount. So when we pay it, we're going to pay $1,050 minus the discount of $20. So our cash is going to be a credit of $10.30. We're going to debit accounts payable for the whole thing though, $10.50. We got to get it off of there. And that difference is going to be to merchandise inventory. Now, like I said, I'm not calculating the discount on the $50 on the $1,050. I'm calculating on $1,000 because I'm buying from these people and they're the ones offering me the discount. The person who's in charge of sending it to me, they're not offering me a discount on the $50. That's just $50 I owe them. All right. Long chapter, I know. Let's pause it here and then we'll move on to sales transactions.